Welcome everyone to the halftime report presentation for 2021. We are delighted to have all of you here today at our webinar and looking forward to sharing some important information with you. So I want to draw your attention to these important disclosures. They're the requirement for us to show these. Please take a few moments to review them and let me know if you have any questions at any time. You can go to the question button on the presentation. We're here to help you understand what has happened in the markets in the first half of 2021 and what potentially could unfold in the months ahead. Feel free to ask questions. I'll probably try to get to them at the end of the presentation to keep things sort of flowing. Otherwise, we might get bogged down a little bit. But feel free to ask the questions and we'll take a look at those and try to get back to them later. Remember, chances are if you're thinking about something or you have a question, probably somebody else is. So don't be shy. Go ahead and put your questions in as they come up. I'm going to try to answer all of them to the best of my ability. One of our goals today is to discuss some factors that have influenced 2021's market performance thus far and then review the underlying fundamentals. It would be impossible to cover everything that's happened so far this year, but we believe that focusing on some key developments may help give a clearer picture of the markets. Today, we'll review what we've been through in the first part of the year, some key economic fundamentals, and what may lie ahead in the second half of the year. This broad view is designed to help you stay informed and give you a better understanding of some of the perspectives that help guide our investing process. Let's begin by reviewing how the stock market performed during the first half of 2021. Here is a snapshot of the S&P 500 index performance from December 2020 to May 2021. The S&P 500 index tracks the market capitalization of 500 large domestic stocks. The index is commonly viewed as a benchmark for analyzing the performance of the overall U.S. economy. Let's look at some key events that affected stock market performance in the first half. As we review these milestones, keep in mind that the period was marked by an unprecedented combination of economic recovery from an historic economic contraction, fiscal stimulus, and continued monetary accommodation. This set of conditions won't last forever, so investors should expect that the return and principal value of stock prices will fluctuate as market conditions change. The S&P 500 climbed rather steadily through the first 6 months of 2021, despite the headwinds of political uncertainty and a slow start to the vaccination rollout. As the inauguration of President Biden proceeded on schedule, investors were soon able to focus on the economic fundamentals and in progress in managing COVID-19 infections and getting Americans vaccinated. Markets were lifted by a series of positive developments, whether in the form of additional fiscal spending or the acceleration of vaccinations. March saw some particularly noteworthy developments with the passage of a $1.9 trillion stimulus spending bill and the milestone achievement of 100 million vaccines administered. In April and early May, markets then reacted to solid economic numbers, highlighted by the April jobs report and calculations that the U.S. economy grew at a 6.4% annualized rate in the first quarter. Markets also digested an inflation report that showed a 4.2% increase in consumer prices on a year-over-year basis. So we've talked a bit about the S&P 500 and how it performed during the first half, but how does the performance compare to expectations? Let's explore this a little bit. At the end of each year, various media outlets compile many Wall Street analyst predictions for the year ahead. This slide shows several projections shared at the end of 2020. How do those predictions compare to reality so far? Well, from the previous slide, we can see that the S&P 500 closed May 2021 at 4,204. The S&P 500 ended 2020 at 3,756. Some of the forecasts for 2021 were aggressive and some were a bit more modest. As you can see from the table, the market has already exceeded one analyst's forecast. Though to be fair, the year is not yet finished. Many market watchers also felt coming into the year that the market would see its biggest gains early as economic activity and corporate earnings picked up. The second half of the year, however, was much more of a question mark, and that's what we're entering into, obviously, going into the second half. Predicting where the S&P 500 will be by the end of the year is always challenging, as you might imagine. And while some of the uncertainties with the pandemic have abated, there are other uncertainties emerging that we'll discuss as we move through this presentation. Now, it's worth repeating that the S&P 500 Composite Index is an unmanaged index that is generally considered representative of the US stock market. Index performance is not indicative of past performance of a particular investment, and past performance does not guarantee future results. Individuals actually cannot invest directly in an index, and the return and principal value of stock prices will fluctuate as market conditions change. And shares, when sold, may be worth more or less than their original cost. Just a few caveats to remember. With the approval of several vaccines, more effective vaccination efforts, and the additional fiscal stimulus, market sentiment improved as investors became increasingly optimistic that the country might avert another wave of COVID-19 infections, and the pieces were in place for a broad economic reopening. In the following slides, we'll take a look at the country's progress in fighting COVID-19 and examine how this progress was reflected in key drivers of stock market performance. This chart shows the relationship between changes in the S&P 500 performance and the 12-month forward earnings per share, or EPS. As you can see, the two lines have generally moved in the same direction over the past decade. But what has happened in the last year? The volatility in stock prices and earnings is the result of COVID-19. As markets rebounded in the expectation of economic recovery, earnings appeared a bit slower to track higher stock prices. And I think that's pretty important to note. Thus, a wide gap between prices and earnings was created. Will they drift back to their historical relationship? That's an unknown that only time will reveal, though the general common sense is that the trend is, or a reversion to the mean is where we end up going. Now let's take a look at some economic and financial indicators to help understand how we got here. To put today's economy in perspective, let's look back to January 2011, when it appeared that the 2008 credit crisis and subsequent recession were finally receding. Here you see 20 speedometers representing 20 leading indicators, from corporate profits to energy costs. 16 of the 20 indicators were some shade of green, suggesting the economy had finally reached a solid foundation. Just one indicator was red, and that was the political environment. Now, fast forwarding to January 2021, 10 of 20 indicators reported positive or strengthening numbers, but you can see that an equal number of indicators had a neutral or negative rating, in particular the political environment and geopolitical risk. By May, the speedometers indicated a much improved outlook. 17 were green, 3 were yellow, and none were red. I mean, that's within basically one quarter, we had a massive shift in sentiment as these leading indicators suggest. These improving conditions reflect a number of key developments, including an acceleration in vaccine distribution, falling new infection cases, additional fiscal stimulus, and improving economic numbers. Let's spend a few minutes looking at the path of COVID-19 infections and vaccinations. Some believe progress on the health issue was a necessary precondition to economic recovery. In fact, indeed, it does look to be that way. As the chart illustrates, new COVID-19 infections appeared to have peaked over the latter part of 2020 and early 2021, followed by a sustained downward trend by mid-January. This persistent decline helped investors believe we might avoid another strict lockdown, and indeed it does seem to be the case. One of the reasons for the downward trend in new COVID-19 cases was that Americans were being vaccinated in greater numbers. After a slow start, the involvement of national drug retailers helped accelerate the pace of vaccinations in March and April. As the chart illustrates, about 50% of the U.S. population had received one vaccination by June, setting the stage for a broader economic reopening in the second half of the year. In addition, nearly 90% of people 65 years of age or older had received at least one vaccination shot. And I think just a couple of days ago, the administration announced that at least 70%, so this would be by whatever, August 1st or whatever, at least 70% of the US population has received at least one shot. So that was a big milestone that the administration was targeting. That's why they made the announcement. So I think that kind of progress is important to keep in mind as we look forward into the second half. At the highest level, the Federal Reserve has three functions: to provide an effective payment system for the U.S. regulate banking operations, and conduct monetary policy. When conducting monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold its monetary policy, well, one of the indicators monitored by the Fed is the overall level of consumer prices, which helps it determine whether to adjust interest rates. The Fed has stated that it's comfortable with inflation in the 2% range. And in fact, actually, there's been a shift over the last couple of years to look at a rolling average of inflation and not just the quarter on quarter inflation, where they're allowing the rolling average, if it doesn't reach 2%, allowing the monetary conditions to stay the same, even if the current quarter inflation is higher than 2%. The idea is that the Fed wants to see inflation, wants to see growth in the economy, and is willing to let the economy run a little hot, at least on a rolling average basis, so that we can achieve sustained growth. This line graph shows the core consumer price index over the past 50 years. The core CPI tracks what urban consumers pay for a specific group of goods. This measurement doesn't include energy or food because those prices, as we know, are often volatile. Some economists use this measure to track inflation. And you often see inflation is the CPI and CPI is inflation, for instance. As you can see in the last ticks on the chart, the pandemic's influence on inflation trends was dramatic but not unprecedented. For example, when most states were urging residents to stay at home in May 2020, energy CPI dropped 18.9%. This deceleration in inflation did reverse in the first half of 2021, especially as the economy opened up, as pent-up consumer demand and supply chain constraints sent prices higher. Inflation worries have crept into the market for sure, and it was all plastered all over the newspapers. And we'll discuss those worries and what they mean for investors a bit later in this presentation. Let's take a moment now to talk about wages and unemployment. This graph shows the unemployment rate and year-over-year wage growth for the last 50 years. Do you notice anything about how these two lines are related to one another? Most of the time, wages and unemployment have an inverse relationship. When one goes up, the other goes down. Notice how wages rose while unemployment spiked during the pandemic period. One of the reasons for this break in the wage growth and unemployment relationship was that job losses were mostly in the low wage areas of the economy that were shut down by the pandemic, such as hospitality industry workers. Remarkably, just a year after unemployment jumping to nearly 15%, the unemployment rate has actually dipped to its 50-year average to about 6% once again. Hiring picked up in the first half of the year thanks to the widening economic reopening and broader vaccine distribution. Many economists expected the recovery in the labor market to continue as more and more Americans look to travel and spend. The University of Michigan Consumer Sentiment Index is one of the most widely used sources to help analysts understand how the average consumer feels about the economy. This index is extremely valuable as it surveys at least 500 residents of the continental U.S. by phone each month. The survey uncovers consumers' opinions regarding their own finances as well as business conditions in the country. Understanding how people feel about the economy is essential because consumer spending accounts for more than 2/3 of gross domestic product. As the chart indicates, after a pandemic-induced drop in consumer confidence, the American consumer is beginning to feel much more confident in 2021. In March, for instance, consumer confidence reached its highest level in a year and indeed appears to be trending higher. Housing is an important contributor to economic growth. New housing starts can increase demand from everything for labor and construction supplies to appliances. At the same time, existing home sales can fuel an increase in home improvement projects, which in fact we've seen a lot of. We've seen that influenced in the housing supply sector, namely like Home Depot, Lowe's, and some other companies. After a pandemic-related slowdown, the housing market started trending higher in May 2020. We've all read the stories of pandemic driving interest in homes outside of crowded metropolitan areas, or the shift to at-home work, creating the need to find a new home with additional room. While it's difficult to say what's next for housing, the outlook for mortgage rates and consumer sentiment is certainly going to play a major role, and we're going to be keeping a close eye on those going forward. It may surprise some of you to learn that Americans' balance sheet improved in the wake of one of the nation's most rapid and deepest recessions, which of course was ignited by the economic lockdown caused by the coronavirus. As the chart shows, Americans' net worth rose throughout 2020 while liabilities actually stayed flat. In part, a stronger balance sheet was the result of a sharp recovery in stock prices in 2020, which we saw, and other assets, and the massive fiscal stimulus that sent trillions of dollars to American individuals and businesses. Basically indicating is that the stimulus dollars were used to shore up balance sheets, pay down debt, or just increase savings in general. Before we move on to our outlook for the second half of 2021, let's take a moment to consider the variables that could upend such forecasts. We see three major possibilities that could upset the otherwise optimistic outlook that has so far driven markets higher in 2021. The first is inflation, which I mentioned before. The Fed has remained very steadfast in its position that inflation is likely, but will be transitory. As a consequence, it sees no need to change its current accommodative monetary policy regime of near zero rates and its bond purchase program. But what if inflation is not transitory? What if inflation regularly exceeds the Fed's goal of 2% inflation? Indeed, if you're reading any of the financial press, that has been one of the main topics throughout the first and second quarters. Another risk is bond yields. Many investors expect bond yields to increase for a good reason. Strong economic growth will drive demand for credit. But if that increase is higher and quicker than anticipated, it could unnerve investors. A deceleration in the growth of corporate profits also looms as a potential risk risk to the economy, particularly in the stock market in general. Finally, there's always a so-called black swan event, something that no one expected, like a pandemic, which one might argue that's indeed what happened in 2020. We had a black swan event that wasn't really baked into any of the expectations. Of course, no one can predict what will happen in the future, but we hope that the following perspective helps you understand what we believe to be on the horizon. Now let's dive into forecast for the second half of the year. After the 2020 fall in real gross domestic product, or GDP, due to the pandemic-induced economic lockdown, real GDP rebounded. As you can see from the chart, the Fed is expecting real GDP growth between 5 and 7% in 2021, and above average growth again in 2022. However, in the long run, the Fed sees GDP actually settling down into its more historic norms, the 2% range or so. Some market strategists look at the bottom-up earnings per share to help set their price target for the S&P 500 index. When setting a bottom-up earnings per share, market strategists focus their attention on estimating earnings for all the S&P 500 companies. By contrast, a top-down investing target price places a greater emphasis on macroeconomic factors when making an investment forecast. The chart shows the bottom-up EPS and the price S&P 500. But a word of caution on this type of analysis. Just because the Q2 2021 or second quarter 2021 bottom-up EPS has trended higher in recent months and the price has trended lower, that may not mean that the market is actually undervalued. As you can see in the chart, there's only a loose correlation between Q2 2020 bottom-up EPS and the price. So it's just something to bear in mind. Earnings per share is definitely a driver of market valuation, but market sentiment is also baked into that. So we can have times where the valuation or the price that people are willing to pay per earnings can be higher or lower depending on sentiment. The first half of 2021 witnessed growing anxiety about inflation, which we've touched on already a little bit. Inflationary pressures exerted themselves in everything from commodities to consumer goods. There are several reasons for this, such as supply chain bottlenecks as businesses attempt to return to normal, and an uptick in consumer spending thanks to a combination of pent-up demand and fiscal stimulus payments. The concern with inflation is that it may require the Fed to begin tightening monetary policy sooner than anticipated. The Fed remains steadfast in its belief that the acceleration in inflation is going to be transitory, thus requiring no immediate actions to curtail it. There's a lot of people that are, try to bet against the Fed and what they see. Historically, that's been a pretty losing bet. But we just have to see, because we're kind of in unprecedented territory, at least in terms of, a pandemic-induced economy over the last 100 years. We just don't have a lot of data on it. The markets may not entirely agree with the Fed then. According to data on investor 10-year inflation expectations, as you can see from this chart, inflationary expectations are actually rising. So the markets are actually expecting higher inflation. Increased inflation, to be sure, was something that investors largely anticipated given the economic rebound from pandemic lows. However, this chart also says that the market seems to think higher inflation may be more persistent than the Fed believes. The next 6 months should provide a better picture of inflation, indicating whether rising prices stay close to the Fed's 2% target or if monthly inflation reports suggest a more sustained move higher. These are all, consensus opinions. We can talk a little bit more about in the Q&A session about what I think, which is, a single person's or a single investor's view. But we're going to dive into that hopefully a little bit more in our discussion. Investors' inflation concerns may mean that Wall Street keeps one eye on the Federal Reserve's scheduled meetings in the coming months. Investors will be listening closely to the announcement coming from these meetings to gain an insight into whether the Fed will maintain its current monetary policy. So what could lie ahead? We don't know, but keep your eye on these 3 dates of the meetings for the Federal Open Market Committee, which are to happen in September 21st to 22nd, November 2nd and 3rd, and December 14th and 15th. Typically, if the Fed is going to make an adjustment to interest rates, it announces those changes in their 2-day meetings. Here's another relationship to understand. Bond prices and bond yields have an inverse relationship. In other words, when bond prices go up, bond yields tend to go down. After experiencing years of low interest rates, many investors may be surprised to realize their bonds can lose money if sold before maturity. Bond fund values may decline during periods of rising interest rate, but a changing tide in the economy doesn't mean you have to abandon fixed income. Often, this movement is an important part of a well-balanced, diversified portfolio that may provide investors the income they need. Obviously, each of your portfolios that you're invested in as clients of Advanced Portfolio Strategies, some are more income focused, others are not. We obviously would need to talk on an individual basis for each of your asset allocation decisions, but bear in mind that fixed income and the steadiness and the low volatility of fixed income is still something very important when we talk about managing risk. However, keep in mind there is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. That diversification can optimize returns relative to the overall portfolio risk, but it doesn't necessarily protect against what we call market risk or systemic risk, particularly as it relates to equities. So there are things at market risk that every portfolio is going to be subject to. What diversification does is try to optimize the specific risk that you're taking in your investments relative to the overall risk and relative to the gain that you're trying to accomplish. Tuning out headline noise while managing your finances is not always easy. However, wise investing involves more than reacting to headlines, for example, that may discuss consumer sentiment or geopolitical developments or even COVID news. For investing opportunities, one approach is to stay focused on fundamentals like the company's earnings or economic data. Now, we've gone over a lot today, and if you remember just one detail from our presentation, we hope it is this. Emotions have no place in investing. Market corrections are a normal part of market cycles. We saw a vivid and compressed illustration of this between March and May 2020. In May 2020. This chart shows the intra-year lows each year going back to 1980 in yellow, with annual returns shown in gray. In 2020, we experienced a 34% decline intra-year. I mean, that is incredible, a 34% decrease in value, even though we ended up a very volatile year with 16% gain. It is incredible, and it's definitely a powerful roller coaster ride to go on. Volatility obviously can be uncomfortable, but it is normal, and that's the point here. Managing your emotions during good times is just as important. Ultimately, taking a long-term view of the markets is essential when pursuing your long-term goals. If you ever feel concerned or want to understand what's happening, lean on us for support. Give us a call, schedule a meeting. We regularly send out our schedule link for you guys to book a one-on-one meeting with us so we can talk about it. We're here for you, and obviously we want to help you make the most of your financial life and those involved making decisions. So definitely feel free to book an appointment. Tuning out the noise is an important part of managing your investments. This slide shows why it's important to do that and focus on your time horizon, risk tolerance, and goals. If we look at the past 15 years, we can see the danger of missing some of the market's best days. As the chart illustrates, a $10,000 investment on January 2nd, 2006 would have increased to more than $41,000 by the end of 2020. Had an investor been out of the market and just missed 10 days of the best days during this period, that investment would be worth less than half as much at $18,829. If an investor missed just 20 of the best days during this 15-year period, they would have had an annualized rate of return of less than 1%. Miss 30 or more of the best days, an investor would actually lose money. Investors who sell stocks in response to difficult market conditions often missed all those important best days because they often occur when everything seems so negative. That's an important point to consider. Finally, before we move on to questions, I wanted to let you know about our open house party at our new Torrance office. We moved in the early part of March, actually finished, I think, about April of this year, and we opened up our new offices. So to celebrate, we're having an open house party on Friday, August 27th, 2021 at 4 p.m. until 7 p.m. So it's come whenever you can, but that's generally the time frame. We'll have drinks, hors d'oeuvres, and you'll get a tour of the new office. And we do look forward to those who can be here to seeing you here and celebrating. So we've gone through a lot of information today, and I'm sure many of you still have lingering questions. So let's take a moment to look at the questions here, and I'm going to see if I can find those on here, Q&A. Here we go. I don't see any questions just yet, but I'm going to give you, I know you have questions because every time we do this, you have questions for me. So feel free to sock away. Give me the toughest one you have about anything that concerns you or anything about the markets or the economy. Love to take a stab at it. Alternatively, if you don't want to ask a question, obviously you can feel free to email me or contact Glenn or myself, and if you have any specific questions. So we do have one question popping up here. What are the main long-term effects of QE or quantitative easing on the markets and the economy? That is a very good question because I think there's a lot of misconceptions about QE or quantitative easing. Quantitative easing generally is the practice of the Fed to artificially or intensely suppress interest rates by buying up bonds, doing a bond purchase program, and setting interest rates low, which has the tendency of increasing monetary supply. There is a theory out there that when monetary supply goes up, that inflation is inevitably going to happen, and a lot of gold bugs adhere to this. When I say gold bugs, people who invest in gold, they adhere to this because they think inflation is coming because monetary supply is increasing, so they're trying to hedge that by either buying gold or some other type of asset that acts as a hedge. Now, there actually isn't really a lot of support for that position. There's not a lot of data to support that. There just isn't a strong correlation between monetary supply and inflation. And we've seen, particularly over the last 20, 30 years, as interest rates have become more accommodative and they've fallen from, very hot, the highs of 1980 all the way down to where we are today. And we haven't really seen a drive in inflation. What I can say is inflation is more linked to wages and wage growth rather than monetary supply. So the question really then is, does quantitative easing affect wages? And it's not clear really what that would be. It's not clear that there's a direct link between the two. However, what we have seen in this last year is money, stimulus money going direct to businesses, small businesses, and individuals has definitely helped in increasing what we call the velocity of money and the spending. And the pandemic has also, I was reading this morning, has increased the retirement of baby boomers. It was the biggest increase ever in retirement of baby boomers. So the labor supply is contracting, which could have an impact on wages as businesses fight for, talent and skilled workers. They may have to pay a premium for that. It's not clear that that's going to happen yet, but it seems to be that there is a little bit of push in wages. That could potentially be inflationary, and that certainly would require that the Fed take a different position on quantitative easing. And if they continued quantitative easing in that environment, we very well could see an inflationary impact. That's what they're looking at. That's the bigger picture. They're more looking at the wages. So that's why wages are important to keep an eye on, because sustained wage increases could certainly have an impact on inflation, and that would almost invariably mean the Fed would have to lay off on the quantitative easing, stop its bond purchase, and maybe even start draining down its bond portfolio and then raising interest rates. So, and that's what we've been seeing in this whole inflation discussion in the first half is, where is this really going? I am sort of dovish on inflation personally, because the big deflationary forces, which are global trade and technology and automation, still have not been addressed. Just because you have higher wages doesn't mean that technology and globalization can actually suppress that trend. So I'm still a little dovish on it. I don't think it's going to be an issue. That's sort of one investor's viewpoint, and that's kind of the viewpoint that I've taken in my discussions with some of you as our clients, but we have to see. There's another question here. Any projections on how the latest COVID surge driven by the Delta variant might affect the markets in the second half of the year? I was hoping somebody would actually ask that question, because if you go back to that chart, in fact, maybe I can go back to it real quick and show you guys this chart, which I think is telling. This daily trends. So this chart has not changed even with Delta. It's really, we've seen there's a little bump here at the end, which is probably not in these figures. There's a little bump, but it's not even remotely close to that peak, not even remotely. And the Delta, while more contagious, meaning it spreads faster, isn't necessarily more lethal. So, and also you have people who are vaccinated who can get it. I just think that the news, again, this might be more of a personal opinion, but I think the news is hyping this up more than the actual data seems to indicate. I think we are on the tail end of this. It's not surprising to see a little bump because of Delta, and maybe there will be even one or two more variants that come out of this current wave that will. But I don't think we're going back to a situation where there's going to be a lockdown. So what that means is we are definitely going to continue to gradually reopen. In terms of longer term effects, I think on one sense they're positive. I think they're interesting, and that is the COVID-19 definitely accelerated trends that were already in place, such as automating, for example, checkouts. You go and the checkout lines, and so businesses have started adopting more technology than they have in the past. But I think that's deflationary because it means that we're not going to need as many workers. So I think that's actually a deflationary force, which will keep interest rates low. And it's also an investment opportunity to invest in what we consider thematic growth opportunities, both in technology and in various economic trends, which we've introduced into our innovation series of portfolios for our clients. We've introduced what we call thematic growth, trying to take advantage of some of these trends. So it is having an impact. It's accelerated these trends for sure. I don't think we're going to see lockdowns, which would have a real dramatic effect on the economy. So the bigger question is then, okay, from an investor's point of view, have we gone too far? Are the valuations too high relative to the earnings? We certainly, the surge in stock prices, I think, was warranted because the earnings per share has definitely increased. We've definitely seen a nice uptick in earnings growth for the general market. So I think it was warranted. We might be sort of at the tail end of that repricing. And all I can say to that is expect some volatility. I expect volatility to remain on the higher side. That other chart that we looked at where it said the intra, let me see if I can find it, the intra year, if I'm going there, the intra year. So we saw 34%, and it says here, the intra year average is 14.3. Some years that average has tended to be falling. I mean, maybe we can see going forward over the next couple of years where, maybe we're at the average or a bit higher, where we're going to see a little bit more volatility as the market's trying to figure out how to price these changes in. So hopefully that answers your question. Next question is, adding to your question, the flow of rumors for another shutdown due to the Delta variant is increasing. Do we expect a quicker stimulus response from the government? That's a good question. I don't know if there's much appetite to do direct stimulus. I don't even think there's much of an appetite for many, at least from what I'm reading, that there's many of the governments really want to go back into a lockdown. I think they're focusing their efforts more on vaccinations and figuring out how they can either incent people to get the vaccination, like giving them free beer or $100 to get a vaccine, or how they can crack the whip or use the stick and potentially force businesses to require people to be vaccinated, et cetera. I think that's more where we're going. I don't think we're going to a lockdown. So I don't think there's going to be much. And also the stimulus is like, we've had 2 or 3 major stimuluses. The next stimulus coming is in the form of infrastructure spending. And I think that's what is being hammered out on a federal level and will be hammered out as, the states will receive that funding and how they're going to go about doing that. So I think that's where we're going to see the stimulus going forward. And that's a really good question, but I would not expect additional stimulus in that regard. Now, there could be other things like childcare support, et cetera, those things that are not necessarily COVID related or Delta variant related. They're related to longer term policy issues that certain segments of the government have been pursuing and are trying to take advantage of right now. Hopefully that answered the question. That was a good one. Will you advise further diversification this time with so many questions, international commodities and real estate? That's a really good question. I think that, it's interesting that you say about, especially about international, because depending on where you're investing from, most countries tend to over allocate to their domestic country or region, if you will. Part of that's currency reasons. As an American investor, it does seem that valuations seem to be better in other areas like Asia and Europe than here. So for like companies, valuation seems to be better abroad, and even within this S&P 500, we saw a shift in the early part of the year as inflation scares were coming before. We saw a shift rotate out of technology into value stocks, so out of growth and into value, with the idea that higher commodity prices and it would pass through to higher consumer prices, so they're affecting consumer goods and stuff like that. I was not subscribing to that theory. I did not believe in the inflation play, and so I did not really believe in the rotation. So far, my conviction has been vindicated because we saw value go up and we saw it come right back down, mainly because the same deflationary forces were in play. Still going to be hard for commoditized, albeit cash flow, dividend-paying companies to really grow. And so those are really a play on dividends. Getting back to your broader issue about allocation, we're big believers in broad allocation in between those areas you talked about, domestic stocks, international stocks, to some extent commodities, and real estate, and also what we call alternative investments. Alternatives would be, commodities might be deemed alternative, as are some of the things like private credit and things like that. Further diversification, I don't know if we'd take it further because we have pretty well diversified portfolios. So I don't know if we'd take it further. We do subtle shifts in our allocation for our investment, our innovation series, which are our asset allocation series. We do make subtle shifts in those from time to time, but not anything dramatic like taking down U.S. investments by 10% and increasing international. We wouldn't be doing something that dramatic. It would very much be on the margin, and because diversification, we have very diversified portfolios, and we do have our analysis supports that our portfolios are reducing risk relative to return. Now, each individual investor is going to have their own particular interests and preferences as well. So to some extent, if you're looking to do some unique diversification, there are things like private credit funds or private investments in real estate and things like that may be worth looking at on an individual basis, but that won't necessarily impact our sort of asset allocation funds in general. And then, of course, how your own portfolio is customized is in part dependent on what you need. Like some investors need more income, so we're looking for ways to generate more income and provide more income. Whereas some people are looking just for longer term growth plays and really just trying to grow their wealth. And it may not involve being in things that don't necessarily require further diversification, but rather just diversifying more towards a growth tilt. I hope that answers it, because that question is a really good question, except that I think how we answer that is very much tied to the individual themselves and what their goals and and what the opportunities are available to them. Have we any other questions before we wrap up? I've allocated an hour. I think we're into it about just shy of 50 minutes. So if somebody has another question, I would love to answer it. We go back to the end here. If there are no further questions, I want to thank everyone for taking the time to be here today and listen to what we have to say. As you can tell, I'm pretty passionate, and my favorite part of these is always the Q&A, because I like to get the questions. It gives me an opportunity to kind of add my own distinct comments to those questions. Please be on the lookout for our emails. We send out market updates weekly and monthly, and we try to provide information on some of the news and the trends and things like that. Follow us on social media. We're on Twitter. We're on LinkedIn, Facebook. So we'll bring out some information time to time that way too. And as always, if you like our work, please don't keep us a secret. We'd love for you to introduce us to people who might find the information that we could provide valuable and talk with them about, how we might be able to help them. I do have one more question pop up. How do you think about annuity investments before economic crisis time comes? So there's 2 points to that. One is the economic crisis, about which I think you mean like a recession or something like that. I mean, obviously, if we're talking about full-scale Armageddon, that's going to affect everything, not just, investments. It'll probably affect a lot more things. So I'm assuming we're talking about an economic recession or something like that. Market timing is really difficult, and markets are forward-looking, so they tend to precede economic situations, unless it's like a black swan event, which can happen suddenly and very quickly. So annuities, especially like income annuities or deferred income annuities, can be very helpful in financial planning when we're talking about trying to stabilize your income going forward and having a predictable sort of pension-like income. So those are really good in terms of providing that kind of income. They obviously have ramifications, which is they decrease your liquidity to some extent, so you don't have the same access to those funds, and they almost pretty much removes any opportunity for growth. So we do use income annuities from time to time as part of our planning, but they're very specific in how we put those into place. And so I'm not recommending it for everyone, but for certain people, it's definitely an appropriate use of your capital in terms of creating a financial stream of income that you can rely on and that's guaranteed by the insurance company. So hopefully that advises. If the person asking is interested, please contact us, because I'd love to delve into that more in regards to your personal situation. Any last questions? I feel like it's last call here, happy hour. But we do have a couple more minutes, so if you do have a question, now would be the time to put it to me. And if not, I think that we're just about ready to sign off here. So as I mentioned before, feel free to reach out to us individually, so that we, sometimes that's better in talking about your personal situation. But I do appreciate all of you being here. This is going to be sent out in a recording. Feel free to share that with your friends, people who might be interested or you feel like may need some professional advice in regards to investing and financial planning. All righty, so at this point, close the meeting, and please feel free to reach out to us when you have a moment. Okay, take care.